Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey everybody, welcome back to the Get Real Podcast. Ron Phillips here. Man, we've got some news. I was sent an article by one of our listeners and a longtime client, good friend, and I love the media. You guys know that I love the media, right? Here's the thing. I appreciate when the media actually tells all of the story. Now, typically what happens is you have a headline that grabs attention, and then somewhere deep in the article, they do actually tell both sides of the story. But in this case, that is not the truth. And so here we have a Wall Street Journal article titled, Biden's Mortgage Relief Fuels Higher Housing Prices. It's created another subprime housing bubble and put taxpayers at risk, and Trump should end it. So let's eliminate the Trump and the Biden piece because, well, I don't really want to get into that, but I do want to talk about this housing thing. So they postulate that the reason that house prices keep climbing is because of a program that was put in place to prevent foreclosures. Okay, so this program is specific to FHA loans. Now, they go into the history of FHA loans, right? The problems with FHA loans began quite a while ago. President Obama eased underwriting standards because everybody should own a house. Okay, they increased debt-to-income ratio limits, and then, of course, subprime mortgages, which had anything to do with Obama. They kind of took the place of FHA loans. We'll get into that a little bit later. This article is specific to FHA loans. Okay, FHA loans, as you know, require very minimum down, like 3.5%. Okay, the mortgages are backed by the government. So if somebody defaults, whoever the investor is that bought these loans is going to be made whole by the federal government. So in 2007, 35% of new FHA borrowers had debt-to-income ratios above 43%. Okay, now you're going to have to try to keep track of these numbers. Okay, so this is all the postulation of this particular article. In 2007, remember right before the crash, 35% of new FHA borrowers had debt-to-income ratios of above 43%. Okay, by 2020, okay, so now we fast forwarded to 5 years ago. Okay, by 2020, 54% did. Okay, so now we're above the ratio of 2020. Okay, as housing prices and inflation surged, borrowers became stretched. I think everybody knows that that's happening. And that happened for a couple of reasons. If you'll recall, in 2020, we had a pandemic. I think it was 2020. At this point, it's hard to remember, but somewhere around there, okay? We had a surge of delinquencies, and specifically FHA borrowers had a really hard time with delinquencies. About 64% of FHA borrowers last year exceeded the 43% threshold. Okay, so it's increasing, all right? Now, what they're saying is that the FHA loan portfolio is riskier than it was prior to 2008, okay, prior to the crash. These guys estimate that 79% of FHA first-time homebuyers, okay, have 1 month or less in financial reserves. I don't think that is actually unique to today. I think that is pretty general, especially when you allow people to get a mortgage at 43% or above 43% debt to income ratio. I mean, I can almost promise you that if you do that and you couple it with a down payment of around 3 to 3.5%, the vast majority of those people because they haven't been able to save up enough money to buy the house to begin with without the FHA mortgage, probably don't have a ton of money sitting in the bank. So again, I don't think any of this is like a shock to the system. Okay. So cool graph of the ratios showing the ratios that I just went over going up. No surprise, many are missing payments. Yeah. Okay. Everything's more expensive. They were already at 43 to what they're saying is 60% debt to income ratios. They don't have a lot of money saved up. Of course they are. And all of this started really going crazy under the pandemic. Okay. And the banks were able to just move the late payments to the end of the loan. And the people, remember, we were supposed to have all of these foreclosures. Everybody in my world, and even the people on the media, were saying, get ready. There's going to be this massive wave of foreclosures. Okay. It didn't happen. And the reason it didn't happen is because the banks, generally speaking, well, they're not hurting. And because they're not hurting and their balance sheets aren't hurting, well, they're able to just work with people and not foreclose. So there's not been very many foreclosures. Well, so to speak. FHA, because it's backed by the government, has had this program, okay? So under COVID relief, the Biden administration masked the growing troubles in the housing market by paying off borrowers and mortgage servicers to prevent foreclosures. Okay, I think everybody already knew this. Okay? I think that the thing that maybe we didn't know is that this has still been going on. Okay. Now, I didn't know that. I thought they put an end to that. But the FHA instituted a program that pays mortgage servicers to make borrowers miss payments for them. Missed payments are added to the loan's principal. Okay, so this is hilarious. I love, so when you start to get into these articles and you read them, you have to read what they're saying. Okay, this says that, and this is a quote. The FHA instituted a program that pays mortgage servicers to make borrowers miss payments for them. Now, if that's all I read to you, what would you naturally assume? Because that's a pretty direct statement. What you would assume is that the mortgage payment actually got made. If a mortgage payment gets made, just so that everybody's on the same page, if that happens, the principal gets reduced and interest is paid. Okay, that's what making a payment means. Okay, that is not at all what is happening here. In the next sentence, they tell the truth. The truth is, missed payments are added to the loan's principal, but without interest. Okay? The FHA also pays servicers to cut monthly payments for delinquent borrowers by 25% for 3 years, with the payment reductions also added to the principal without interest. Okay, so the government under President Biden decided that it would be better than foreclosing on these people to increase the loan amount on the back end of the loan and pay the servicers their interest. Okay, so that's what's it's been happening since the pandemic, and apparently this is happening through last year. All right, so that's where we're at with this program. Now, let me just say, if I'm on that program and nobody is shoving me off of that program, why in the world would I leave that program? Why would I make my mortgage payments? I mean, can you tell me why I would do that? Would you do that? This goes back to the same thing where we used to talk about paying people not to work. Well, if we're paying people not to make their mortgage payments, then they're not going to make their mortgage payments. That doesn't take a rocket scientist to figure that out. Okay. Okay, so consider a borrower misses five $4,000 monthly mortgage payments. Okay, first off, that's a really big payment for an FHA loan, but we'll just leave that there. Okay, so the servicer will add the $20,000 in missed payments to the mortgage and reduce the monthly payments by $1,000 for 3 years adding another $36,000 to their mortgage. So the borrower is $56,000 deeper in debt, though with no additional interest. Are you following? If he misses payments again, the servicers are rinses and repeats, getting paid $1,750 every time this happens. All right. The FHA also allows servicers to charge borrowers legal fees. Okay. I mean, that's pretty typical. Again, anytime you're late on your mortgage payment and a bank works with you or a servicer works with you, there are fees associated with that. Okay. The FHA made 556,841 incentive payments to servicers over the past year to prevent foreclosures. Now that is, I mean, I don't know that it's a staggering number, but it is a big number. Okay. Nearly as many as the new mortgages it insured. Now, last year, the reason that it didn't insure a whole lot more than that mortgages, in other words, there weren't that many FHA mortgages, is because there weren't that many sales. Over the last 15 years, typically it's about 1 million a year FHA loans that are insured. Last year, there weren't that many and that's why this number is about the same as new insured loans. Okay. But that paragraph makes it seem like in a normal year, like they're paying off mortgages for people, which they're not doing. Again, they're really not doing that. And it's the same number as FHA mortgages are written every single year, which is not true. One result is that many FHA mortgage borrowers owe more than their original mortgage and more than their homes are worth. Okay. That's probably true for some of these people. I doubt that's true for the majority of these people. Okay. So they're saying that they can't sell. If home prices keep increasing because borrowers who don't pay their mortgages and never should have qualified for the loans can't get foreclosed on or be forced to sell their homes, home prices keep going up. That's what they're saying. That this alone is causing home prices to continue to go up because we're not allowing inventory to naturally hit the market. Okay. I do think this is actually true. Getting foreclosed on these days is like flunking out of college. It takes effort. You have to reject repeated offers for mortgage relief. That's true. It's 100% true. And it's not only true for government-backed loans. It's true for commercial loans. It's true for other conventional loans because the banks have the ability, and of course the government does because they just print money. They have the ability to do a workout with people rather than foreclose. So massive difference between 2008. Now, I know they're trying to compare 2008 to today, and I'll get into why there's less of a comparison, but I just want to, there's a couple of things in here that are true. Taxpayers are on the hook if the FHA insurance fund financed by the premiums on the mortgage, it gets backs, goes broke. That's true. If it goes broke, we're on the hook for it. No question, because it's a government-backed program and we fund the government. No matter what you hear from the politicians who say that when they give us a tax cut, they're losing money. No, it wasn't ever your money. It's our money. Okay. We fund the government. So that statement is actually true. Okay. They're saying the Biden administration built a house of cards that could collapse if Trump officials dare to end the mortgage giveaways. Okay, well, maybe not. And we'll go over that in just a second. Foreclosures would inevitably increase. True. More borrowers would then fall underwater. And it's saying, homes might become more affordable. Maybe. I don't know that any of that is actually true. And here's the reason. Let's do a look back. A little history lesson on FHA mortgages. Okay. FHA mortgages, like I said, roughly between 1 and 1.2 million insured every single year through 2023. In 2023, they dropped to 732,000. Okay. It's a 25% drop. And in 2024, while I couldn't find the actual data yet, it probably dropped again. And why did that happen? Well, because people can't afford the houses now because the interest rates have gone up. Okay. But let's not conflate 23 and 24, where we didn't write very many loans, where the prices were really high, with 12 years of prices increasing and over 1 million loans. That's 13 million endorsements over the last 12 years. I mean, I'm doing rough math. Okay. Now, looks like more than that, but let's call it 13. Okay. That's a lot of loans, folks. A lot of loans. And what they're saying is that there's about 1 million of the 13 million that are in this program. All right. Now, how many of those in the program are underwater? Well, the Wall Street Journal doesn't know. I don't know. You don't know. But it's fair to say that anyone who bought a property prior to, call it 2021, 2020, 2021, they have a fair amount of equity because property values have increased dramatically, and specifically dramatically after the pandemic. And while they have kind of stalled out in a lot of areas in the country and started to even decrease in some areas of the country, there hasn't been a cataclysmic shift yet. And if these people had to sell and they couldn't start making their mortgage payments, again, they're on a program where if they don't make their mortgage payments, it's basically no big deal. Well, once it becomes a big deal, you might find that a large portion of these people actually start to magically make their mortgage payments. I don't know. You don't know. Wall Street Journal doesn't know. And some of the people who can't make their mortgage payments might just sell their house instead of getting foreclosed on because they have equity and they can start over. Maybe they rent because they can't afford properties now. Some portion of these are going to get foreclosed on. They're going to hit the market. But right now in America, in almost every single market, we have a shortage of homes. So even a large number of these over the next year or 2 years actually end up in foreclosure. I just don't see this cataclysmic shift in the market due to these particular loans. Now, let's go back and let's revisit another pretty important thing, okay? And that is that basically prior to the last crash, okay? Prior to the last crash, most of the loans that were actually written, well, subprime loans basically became the de facto FHA loans, okay? Subprime loans had reached $625 billion in 2005. That's 20% of all mortgage originations. Thus far, we've only been talking about FHA loans, okay? Now we're talking about all loans, period, on the market. By 2007, subprime mortgages made up $1.3 trillion. Over double what it was in 2005. Now that's a massive number, okay? By early 2000, subprime mortgages, around 7.5 million subprime mortgages were outstanding, accounting for 13 to 14% of all U.S. home loans. Okay? So I just want to make sure we're all singing the same tune here. To compare the 2008 subprime mortgage meltdown, which was 20% of all of the mortgages, and what is a relatively small number of FHA loans that we really can't even quantify how many are going to be foreclosed on, is not even close to a fair comparison. It is not even close to what is keeping house prices high. But I don't see this cataclysmic fall that the Wall Street Journal suggests in their article. A cursory look back at that particular crash and what really happened and why it was so bad just completely debunks this article. I mean, remember, folks, the regulators forced the banks, because their balance sheets were so upside down, to mass sell off these assets, cutting the prices. I mean, to the bone, cutting prices. And all across the country, even in markets that didn't have massive downturns, they were taking an axe to prices. I've been over this before on the show. A normal foreclosure proceeding, that's not what happens. The banks took these assets back, chopped them to the core, forced them out into the market all at the same time. The market absorbed them. And why wouldn't the market absorb them? I mean, you could buy properties that were 30 and 40% under market in the Midwest that didn't go up that much. So far under the cost of construction, replacement cost. It was absurd, people. That was government regulator mandated, forced execution of the market. And then right after that, the regulators came in and forced all of the appraisers to only use comparable sales. So if you force the market down 30, 40, 50, and in some markets even more than that percent, and the only thing you can do is comp another sale with comparable sales, the banks trash the markets. And then they were held there for way longer than it would have normally taken for the regular market to get rid of that inventory. What we're talking about here is not even close to what happened. Not even close. Are some people probably going to get foreclosed on if Trump eliminates this, which I agree he should? We shouldn't be paying people's, quote unquote, paying people's mortgages. They're not, by the way. We went over that, right? Should the government be in the business of doing that? No. The market will fix that problem, and in short order. So, I will remind you, people have been beating this drum since 2018. Probably earlier than that, but for sure since 2018. The drum beat got really, really loud after COVID. I mean, literally, people were just been out of shape about how within 6 months of that pandemic, January, February of that year, they were saying in 6 months, there's going to be a mass amount. It's going to be worse than 2008. Guys, it didn't happen. Okay. And that was a way bigger problem than this tiny little one that the Wall Street Journal just reported on. Now, I don't know what's going to happen with the real estate market. You don't know what's going to happen with the real estate market. And there's not a pundit on television or who writes articles in the newspaper who knows what's going to happen with the real estate market. We can all postulate what we think is going to happen with the market, but until it happens, nobody really knows. We have 2018, 2019, 2020, 2021, 2022, 2023, 2024. That is 7 years of people being remarkably wrong about the market. 2025 is shaping up to do the same thing to them. That's 8 years. At some point, we're going to have a downturn. And all of these people who have been wrong for 8 years are finally going to get to say, I told you so. I told you so. But run some math with me really quick. All right? Because this is the fun part, right? Let's take a $200,000 property and let's just say that the market went up, I don't know, 5%. It seems like a reasonable number. It's $10,000 a year. $10,000 a year times 8 years with no compounding whatsoever is $80,000. All right. So $280,000 property, let's say the market, I don't know, even if the market loses at 20% of its current value, that property is still worth $224,000, right? A $280,000 property that loses 30% is barely underwater after all of those gains. That doesn't take into account if it was a rental property that you cash flow the whole time, that somebody paid your mortgage down the entire time, and then you got tax benefits the entire time. Buy and hold real estate, rental properties. It's the way to go, people. It's the way to go. And then you never really have to worry about what happens with the market. Just don't sell your property. If the market goes down a little bit, just wait. Time fixes it. And while it's fixing it, you can cash flow, and somebody's going to pay your principal down, and the government's going to give you benefits for owning the property. It's a beautiful thing. So don't go get scared when everybody freaks out about the market. Read into the articles. Do a little bit of research on your own. You can find the same things that I found. You know? Listen. Don't let people scare you. Where fear and doubt are, faith is not. This too shall pass. And hey, if there's an uptick in foreclosures, maybe there'll be some good deals for folks to buy out there. And as soon as those are taken off the market, guess what's going to happen? Construction hasn't gotten any cheaper. The labor and the materials haven't gotten any cheaper. The land hasn't gotten any cheaper. Until there is a supply-demand mismatch, prices aren't going to go down. Nationally, of course, look locally, right? All right, folks, there you have it. And until next time, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.